GM everyone, welcome to Flywheel, your number one source for everything Frax DeFi and everything in between. If you want to know what's going on in the world on chain, well, you've come to the right place. This is DeFi Dave here with capital K, and we are here to help you harness the power of the Flywheel. And today was a powerful episode indeed. We had on Sam Kazemian himself to talk about FraxETH V2, how the week has been going, and a bonus, everything you want to know about FraxChain and its latest developments. You better stick towards the end because he reveals all and then some. Kit, what are your thoughts on this one?
I think the listeners need to be ready to take notes like right on minute one because we pretty much jumped right in because we only had 60 minutes. We only had 60 minutes. So we went ham right away. So like listeners, readers, pay attention immediately and start taking notes.
This is a quick hour. It'll be over before you own it and you'll be wishing for more. And so if you want more, make sure you hit that bell button, subscribe. Let us know what you think in the comments. Give us a like. Make sure you subscribe to us, flywheeldefi.com. Follow us on Twitter at flywheeldefi. Join the conversation on Telegram at flywheeldefi. Follow me on Twitter at DeFiDave22.
You can follow me at 0xcapital_K.
And let's get the flywheel spinning.
परदेसी नू तेनू नितजार होना पै जाऊगा नाल रंजेठे जोगी दे तेनू जोगण होना पै जाऊगा इश्क दे अलिया जख्मां दे खुद हंस के मुंह सी लांगी जे यार मेरा मैनू जहर दे मैं घट घट करके पी लांगी
Do you hold ETH but don't know what to do with it? Want to earn those juicy liquid staking derivative yields but don't know where to start? Well, FrxETH is there for you. FrxETH is Frax's native LSD solution, allowing you to earn boosted yields in multiple ways on your ETH. If you want to get started, go to app.frax.finance and turn your ETH into FrxETH today. GM everyone, it's the episode that you've been waiting for. And it's the FraxETH V2 episode explainer on Flywheel. I'm your host, DeFi Dave, here with capital K. We have on Sam Kazemian, co-founder, mastermind, humble contributor to the Frax protocol. Sam, thank you so much for coming on for this edition of Flywheel.
Thanks, guys. It's always fun to be on with you.
Yeah. Before we get into V2, let's take a look back on V1. It launched about 10 months ago, back in October. How do you think the performance of FraxETH V1 has been so far?
Yeah, I think, we've come a long way. Objectively, without coloring it in terms of any, it's so cool or whatever. Objectively, I think it's the fastest growing LSD probably in history in terms of how quickly it's grown. Lido has had about 2 years to get to its size. And FraxETH V1 is already, as we speak, about 238,000 ETH in terms of supply. And it's always been consistently the top yielding LSD / stablecoin. You guys know we like to call it a stablecoin system, and I can explain why. But things are great. And also, one of the main, things about FraxETH V1 is we wanted to get it out and in V2 decentralize the validator base. But as you guys know, the validator base is run by the Frax core team. Now, the thing about that is FraxETH V1 literally has the highest rating network on rated.network, which rates validator effectiveness. It has the highest all-time rating. It has the highest, past 30 days, past 7 days. Sometimes it might move between like rank 1 or rank 2, but it is literally the number 1 rated effectiveness rating for validators. In fact, one thing, I think there's like a lot of FraxETH V1 skeptics, and I mean, they know who they are and stuff. But one of the things that I think is really funny is lot of them on Twitter say like, oh, these validators are just like ran in like Sam's basement or something. And I always think that always gets me like a really big chuckle, because it's like, then these validators supposedly in my basement are the best performing in the entire Ethereum ecosystem and in the entire industry. That's
right next to your gym rack, your barbells and everything.
Yeah,
you just have a bunch of like hardware cold servers just like running in the back as you lift.
Yeah, no, but in all seriousness, they obviously are not ran in my basement. They're ran by the core team. Alex, Justin, part of the core infrastructure team, and they are very, very professionally ran with, geographically diverse node. So we run Prism and Lighthouse. And
so there's two client architectures. That's good.
Yes, so right now there's two clients, and basically we mirror it for like the actual distribution, right? Like Lighthouse and Prism are the two most ran and used clients. So our size kind of naturally mirrors the natural validator distribution, right? And like I said, you don't have to take my word for it. Rated.network is like an objective third party, not related to us or any, LSD project or something. And they literally rank FrxETH, or technically the Frax validator base, as the most effective all-time validators. You can literally just go and look at that as we speak right now, rated.network, and you click all. So, I mean, that speaks for itself. That's the FraxETH V1 design in terms of, the validators are ran by us. But the economics of it obviously are very unique. I'm pretty sure most people, listening to Flywheel have seen the 2-token design, right? It's FraxETH is a stable coin. It doesn't yield anything. You can kind of think of it like USDC, right? Or Tether, right? Like these are like stable coins. They don't yield anything. And then imagine if, for example, regulation and stuff aside, obviously, imagine if, for example, Circle had like a staking vault, or like Tether had a staking vault that said, hey, if you go stake your, USDC, right, you'll get the Fed rate or something, right? Like the Fed treasury rate or whatever. And essentially you stake your dollars the same way normal people stake their dollars with the treasury or like with the Fed through, custodians or whatever, right? It's like, treasuries are kind of like staking your dollars, right? So we have this design, but for ETH, right? You have a non-yielding stable coin, and then you have a POS vault. We call it sFraxETH, staked Frax Ether, and you go and you deposit your FrxETH stablecoin in there, and then you get an interest-bearing asset, right? And that's where all of the POS, rewards actually go and get, distributed to people. So that's the FraxETH V1 design. It's worked extremely well. At first, people were a little confused because it was the only, LSD / stablecoin kind of system where there was 2 tokens. People were like, why does it have 2 tokens? It seems, unnecessary or weird, but lo and behold, it's worked even better than we expected. But it's definitely been a huge success.
All right, so that's Frax V1. Now, when you were designing Frax V2, what design considerations and what priorities were there for the Frax core team in constructing it?
Yeah, so Dennis, who's another part of the core team, had talked about this extensively, which was the issue of obviously fully decentralizing and making it entirely trustless, both in terms of node operators and just everything being on chain, no M6, no nothing, right? There's a few things to think about, right? One is if everyone can run a node, right? Which is great. It's very inclusive. It's awesome. There has to be some market mechanism to select for the most performant, most sophisticated, and best entities that know how to run good nodes, whether that it's MEV revenue or low costs for them running nodes and like the highest internet speed, right? Block propagation, attestation responses, and stuff like that. So there has to be a market mechanism that just actually selects for proficient node runners, right? Like that's one thing. And number two is that if you're going to fully decentralize, you're not going to, for example, KYC people who run nodes, or you're not going to like keep the like reputation scores or something like that, and you're going to make it truly fully trustless. There's going to have to be some amount of collateral in some way, something put on chain, right? It's impossible for there not to be. If POS is risky, you could get slashed, right? There's going to have to be some amount of collateral, and that amount of collateral does bring the capital efficiency of the system down, right? And the capital efficiency going down means that the LSD APR necessarily goes down, right? It affects returns. And this is actually something, we could talk about. This part of the reason, for example, like Rocket Pool's RETH always has a lower APR than like Lido's. But, for the lower APR, obviously anyone can run nodes. The reason for that, the reason RETH is a lower APR is like people have to come and put their own ETH as collateral, right? And so the POS yield is finite, right? The Ethereum protocol gives some POS yield to stakers for each validator you run, right? And that actual yield has to get distributed between both people who put up some collateral and the people that hold RETH, right? And so this kind of push and pull is something that we wanted to solve with FraxETH v2.
Got it. So, you released it this week and everything. I mean, you released the news of it this week on Dora Hacks. And it got quite the response. You went to the Rocket Pool Discord. You also answered a bunch of questions, both online and in the Telegram. How do you think the response has been to FraxETH v2 this week?
I think it's been huge, right? Like just looking at the massive, right? In terms of both people on Twitter talking about it, the total impressions, just everyone, like you said, Rocket Pool discussing it on their Discord, and they're all great guys. They're very, very smart. Honestly, probably the smartest in terms of knowing how to run nodes and these kinds of things, dissecting it. I think it's probably helpful to discuss kind of the basic aspect of what FraxETH v2 actually is. And so the way that we think about it is that all LSDs are lending markets. And so this is kind of weird because no one has really said this before until we came out with, FraxETH v2. Just like close your eyes and think about, for example, Aave, right? Aave, everyone knows it's a lending platform, right? You can put some collateral and you can borrow something out of it, right? When you deposit ETH into Aave, right? What do you get out? You get AETH, right? The Aave rebasing token, right? And if someone wants to go borrow that ETH, what do? They have to go put up some other kind of collateral, right? It could technically be anything that Aave accepts, right? It could be stable coins, it could be other volatile assets or something, right? And then they get to take the ETH and then they could do whatever they want with it, right? They could go sell the ETH, they can hold it or whatever, right? And then they pay you, the AETH holder, right? The lender of that ETH, they pay you some interest rate, right? Decided on based on the utilization function, right? It's like there's no central person, moving the interest rate. It's all based on an algorithm, right? So we started with that first principle and we said, okay, like imagine if that was the case, and instead of you being able to just take the ETH and go do whatever you want with it, like sell it on Uniswap or whatever, what if there were just smart contracts that made you only able to do one thing with the ETH, run a validator, right? Instead of the ETH going directly to your, EOA or something, right? The ETH gets immediately pushed into the staking contract, right? And a validator spins up, and if you have your validator public key, like you yourself, right? You actually publish your validator public key in that flow, and the ETH that's staked attaches to your validator's public key. So you can start actually validating with your validator, right? It's actually basically in your control. Now the withdrawal key obviously goes to the FraxETH v2, the protocol's withdrawal key. That's part of the point, is so you can't just take the ETH and run away with it, right? And so we designed this system where, think of it like Aave, except instead of taking the ETH and going to Uniswap and selling it, the only thing you can do is send your validator's public address to it, right? And it'll bind it to that ETH, and then it'll stake the ETH for you, right? And then you get to do stuff, make blocks, attest to stuff, right? And as long as you just pay the interest rate to the AETH holders, right? Think of the Aave situation again. As long as you just pay that just through your earnings or through, whatever, you can just keep the loan open, just like Aave, right?
Yeah.
And so that's the basic first principles thinking of FrxETH v2. And if you think about it more, this is how all LSDs work. It's just like it's kind of slathered with different words like stake the LSD token, or like spin up a node and do this and that. It's just a lending market. It's just lenders and borrowers that actually make it work, right? A lot of the things, like when I was talking on the Rocket Pool Discord, one of the things they were saying is, I'm not a borrower, I do work for the protocol or something, right? And it's like, yeah, you do, but the economic modeling of it is a loan, right? Like, you don't own the actual ETH. It's just like a house. If you got a mortgage, right? And the house, technically, the title belongs to the bank, right? But you live in it, you get to, do stuff in the house or whatever. It's the same thing. And so the whole idea is that if you treat it like a lending market, right, it's basically the most efficient LSD protocol, because everyone that is good at running a validator will want to borrow ETH, right, and start validating, keeping the MEV and the POS yield and stuff, and paying just the interest rate, right, to the actual lenders, right? And the final piece of it is, instead of AETH, right, the token you get from Aave if you deposit ETH, the AETH is just FrxETH, right? It's just FrxETH, and that's the token you get. And if you want to earn the interest, you just go stake it as FrxETH, right? It just goes into the actual interest bearing POS vault, right? And the thing is, this system actually helps with the two challenges I was talking about, which is making sure that the most performant node operators always are the ones running nodes, and also making sure that literally the effectiveness rating and the best validators are always the validator base of FrxETH v2 if it's not going to be the core team that's running it, right?
Yeah. So basically, you guys had this challenge with V2, and the challenge was, how do we keep our 99.9% top-rated, ETH staking system going, and how do we decentralize at the same time? And in order to do that, you went to this first principle thinking of like, okay, like how do we, what is, LSDs? They're just lending pools, and we're creating a lending market. How do we create this lending market? And you have this, like you said, this Aave peer-to-peer pool model going on. When I was
actually, let me just exactly. Like, you could even think about it like, honestly, like if Aave wanted to get into the LSD game, right? Like the way that they're starting to get into like the stablecoin game, right? They're launching Go soon or something, right? Yeah. They could just make a system where, like you lend ETH into like an Aave market, right? And then like the Aave core team or something runs the validators and then distributes the interest to ETH holders, right? That's essentially like FrxETH v1, right? And then they can update that system where then after a while, when you go and lend ETH in Aave and you get out ETH, then it's not just the Aave core team, but someone else can collateralize it and run the validator if it's profitable for them, right? If they're very sophisticated, they get a lot of MEV and they're willing to pay the interest rate to ETH holders, right? Like Aave could do this, right? It's very sound. It's economically exactly how Lido works, right? Lido, in fact, the funny part is Steth is rebasing just like Aave's ETH token. They both rebase, right? It's literally the exact same code, except the difference is like Lido has these partners, right? The 29 or 30, however many there are, professional, node running, entities, right? And they send the ETH to them, and then they run the validators, and then they distribute the rewards after taking a fee, and then the node runners taking their cut and stuff as well. Then it gets rebased into stETH. It's the same thing, right?
Yeah.
Right. And Sam, let's go back to FraxETH V2 and dive a bit deeper into that utilization rate and how that interest rate is calculated. Well, actually, let's first start with how much collateral do you have to put up? What's the LTV here?
Yeah, so that's a great question, and part of the heart of the design, right? Right now, our modeling and kind of our own view of it is that it can be 4 ETH of collateral to
4
actually
ETH.
4 ETH,
Wow.
to actually borrow 28 ETH for this easy meme, right? And to borrow 28 ETH and then combine it, right, to spin up a validator, which is 32 that is borrowed, right? And that actually makes it twice as efficient as Rocket Pool, right? But one thing I want to highlight as like a caveat is like obviously VFXS holders have to vote on the LTV of these. They control all of the actual loan parameters, right? So while I actually think that I would personally vote for 4 ETH, right? I think that at the launch, VFXS holders should decide. But this makes it twice as efficient as Rocket Pool, which is currently 8. They recently updated their the Atlas upgrade, which lowered the collateral requirements from 16 ETH to 8. We think 4 is good. There's obviously design trade-offs for that. For example, the actual risk of slashing is based on how contentious a block's attestations are. So, for example, if you accidentally just are running a node and then you double attest to something, that's just 1 ETH, give or take, of slashing. No one, it's not a contentious block. You get slashed, it kind of sucks, and then you get ejected, by the way. So how ETH works is if you get a slashing event, you actually get ejected from the validator queue. So you actually don't even run the node afterwards, right? You get kicked out, and so your nodes are in the exit queue, right? However, if there's an actual contentious block where, let's say, 30% of all attestations are on block A, and then 70 are on block B. Well, first of all, this would be really bad. I don't think this has happened even a single time since POS, but there's going to be a lot of slashing going on. The 30%, the minority, right? They get slashed proportional to how contentious the actual attestations are. So you can actually get slashed anywhere between 1 to 4, 8, 12, whatever. And so these are risks. I want to highlight the actual risks in terms of, for example, right now Rocket Pool has 8 ETH as collateral. If Rocket Pool node operators vote in a really contentious block and a contentious situation, and they're wrong, they're in the minority, RETH could be insolvent, right? There could be a mass slashing event, right? And the node operators can lose more than 8 ETH. 8 ETH is not a cap in consensus. There's never a way to ever get slashed 8 ETH. No, you can get slashed more than 8 ETH. It's just the situation.
It's up to 16. It's up to 16 ETH, right?
There's no literally hard coded number. It's based on actually off the top of my head, I don't know the exact equation because it's actually fairly complicated based on how many attestations are on the other block, but it can be pretty high. It can be very high. And so when there's this collateral factor of 8 ETH for Rocket Pool, and we think we should do 4 ETH, it relies on the fact that those situations don't happen. And so far that's correct, right? But then basically, if they do happen, then it's it's pretty important that the node operators don't vote on the minority block, right? And so that's just the caveat I wanted to clearly say. Like, the collateral factors are important because you basically are trying to guard against those situations, right? So yeah.
Got it. And so, Sam, a quick follow up to that. As obviously 4 is really low, frankly, the lowest in the market. And isn't that kind of extra risky? And a follow up to that is, as the node operators build up a reputation, could they then raise their LTV over time to get even like, 1 ETH if they're on rated.network 99.9%?
Or FraxRated.network.
Yeah, so that's exactly the kind of flexibility and malleability that the FrxETH v2 design allows you to have. I don't know what the future holds in terms of like how things will evolve, but part of the reason when I announced this, I said this is like the most the most flexible, versatile, and kind of a clean slate LSD system to build on, is instead of having to hard code really big updates, for example, right, like Rocket Pool's Atlas upgrade, or like Lido's V2 or whatever, right, their staking module stuff that they announced recently. FrxETH V2 is extremely malleable. You can have like a governance vote that says like, okay, these lending parameters, like the LTV of like 90% is possible for X, Y, or Z things that the smart contract will check, right? They're like validator history or whatever. And so the answer is yeah, if governance approves it, and it's actually just a very simple parameter change, right? It's like a new loan term. But as you said, pretty risky, right? If you lower it, especially to like 1 ETH and stuff, it's always, a risk versus reward kind of thing. But the cool thing is VFXS holders will just be able to control all of this.
Yeah, to follow up on that, like how could, the system protect against that risk? Like, even though, let's say, the FraxETH V2 family of validators are, top tier, cream of the crop, best of the best. Like, let's say some unfortunate event happens. Could there be like an insurance fund? Could there be some backup plan? What do you think? How do you imagine the protocol acting if like the worst of the worst happens?
So right now there is like a small insurance fund in FraxETH.
Oh yeah, 2%. Yep.
Yeah, it's obviously it's not huge, and obviously it's far from needed as the number one rated validator base. But basically, I think there's a important aspect, that if the node operation is fully decentralized, there should be some kind of insurance and failsafe. That's kind of what the collateral is, right? So like exactly, if we're lowering the collateral, you're kind of lowering the kind of insurance, so to speak. And you can always obviously have extra insurance. Again, that's just idle capital that's sitting there. So you should, again, there's no free lunch, right? Risk is
there's
always
no such
kind
thing
of
as a free lunch.
Yeah.
I mean, but that's the thing with insurance, right? Like you need it when you need it, and when you don't, it just kind of eats at your bottom line. And exactly. I feel like, do you think right from the get, are you going to maybe increase the insurance fund, like take from 2% to say 3% a little bit, just to see?
I guess it's up to VFXS holders if they want to increase it.
Yeah, okay, I guess so. But I mean, I feel like we should have a starting line where the insurance fund is a little bit higher, just so that we see like, are the Joe's basement node operator as performant as Sam's basement operators, right? To make sure that they're at the 99% level. Or are we just going to start out the gate with a super low collateral ratio and a super low insurance fund and see if, it'll kind of
I wouldn't say the insurance fund is like that low, but yeah, Sam, go ahead and answer that question.
Yeah, it's interesting you say that, because I think there's like two camps, and I don't want to put words in C2TP's mouth, but one thing he was saying is, do we even need the insurance fund when node operators have to put up some kind of collateral? But then you have your reasonable take, which is, well, the collateral is kind of low, and we don't even know who the node operators are anymore, right? Because they're decentralized. Yep. You don't know their competence and any of that stuff, right? And you might need more than 2% of an insurance fund. So I think there's two camps forming here, and they're both reasonable. And I actually don't know what camp will win, or what governance vote will be put up and which vote will end up winning. But I guess that's kind of what the point of decentralization is.
Yeah. So another question I've been thinking about, going through all the interviews, docs, threads, and whatnot, is this whole concept of you're basically, instead of borrowing ETH, you're borrowing validators, which is quite the nuance. And honestly, the more you've been talking in this interview and saying the only thing node operators can do is operate a validator, it kind of reminds me of EigenLayer a bit, in the sense of like how conditional it is. Like with EigenLayer, it's like you stake and you're like supposed to do a job, and if you don't do that job, you get slashed. Like in structure, and like honestly, it sounds like the same thing. And so can you like go and explain what the nuances between borrowing a validator and borrowing ETH?
Yeah, and it's kind of similar to how I was explaining it in terms of like a house, right? And
yeah.
I think a lot of people would understand this if they're not in the LSD space. Is like, imagine if you were trying to buy a $3.2 million house, right? 3.2 million, 32 ETH, right? Like just like analog there, right? Let's say you had $400,000, right? And $400,000 for ETH, right? And you go to the bank and you say, okay, I want to buy this $3.2 million house. I only have 400K. I need $2.8 million more, right? The bank says, okay, sure, your credit's fine or whatever. The house is good enough collateral, right? They give you $2.8 million. You combine it with your $400,000, right? Now that's 3.2 million. You use it to actually buy the house. But the thing is, the house doesn't entirely belong to you, right? The house, actually, the title is the bank is on the title, right? Because you actually owe the bank $2.8 million, right? And the house itself is the thing that's collateral, right? You basically kind of owe either the house to the bank, right? Or you owe $2.8 million to the bank, right? And so this is kind of the same thing. You go to the FrxETH v2 protocol and you're saying, hey, I have 4 ETH, right? I want to run a validator and I need 28 ETH, right? And so the protocol is like, okay, fine. And you combine 28 ETH with your 4 ETH and you spin up a validator, right? It's the same thing as buying a $3.2 million house when you only have 400K, right? And then you get to obviously like live in the house, right? And here you get to actually run the validator, right? And so the idea is that you can just either eject the validator, right? Give back the 28 ETH, right? And take back your 4 ETH, or you just continue to pay the interest, right? It's similar to like a mortgage where either hopefully you pay back the $2.8 million, right? And the house becomes yours, or you default or whatever, which means the house goes to the bank, right? And so the idea is that the debt is either in the house or in the $2.8 million mortgage, right? Here, the debt is either in the validator or you pay back the 28 ETH, right? And so the concept is exactly the same. Now, one thing is like clearly the question is, well, why would people do this? It's the same reason they would run a node in Rocket Pool, right? You get to keep the earnings, right? You get to keep the MEV, the tips and stuff, and it's very lucrative. If you like running nodes, you know how to run them, and you don't need 32 ETH. You only need 4 to run one, right? And so it's a very lucrative thing, and the only thing you pay is the interest rate to the actual FrxETH minters, aka the lenders into the system, right?
Yeah. So I guess the real world equivalent. Wait, can I go? Into one thing. So the real world equivalent would be like, to continue on the house example, let's say the interest on the house is 5%. And you take, the 2.8 million and you find some like fund or some shit and you put it into like a 10% fund. And then you just take like 5% of that, pay it back over time. And that's basically the same thing of how it would work. Just like continuing on that example, right?
Yeah, like, so one of the main differences is, so the main difference there is usually mortgages are like fixed rate. In TradFi, there's a lot of fixed interest rate. Like if you get a 5% mortgage, likely won't change, right?
Mm-hmm.
In DeFi, all of these loans are essentially non-maturing loans. You can always have them out as long as your LTV is good. And then the interest rate is variable. It changes based on the market, right? And so that's actually how FrxETH V2 works, because the interest rate is based on utilization. And what that means is how many people are doing this, right? They're borrowing, or how many people are repaying. And so the more and more people that are borrowing, the interest rate slowly goes up. It'll, go for like 5%, maybe 6%, maybe 7%, right? And if people are starting to pay back, the interest rate goes back down. It goes like 6%, 5%, 4%, 3%, or something, right? And the idea with that is very simple. It's what is the highest rate, the interest rate that people are willing to pay to actually run a validator, right? What is the actual market set interest rate for the right to actually produce blocks on Ethereum and attest to blocks, which is a very interesting concept, right? No one has ever talked about, no one's built a DeFi like protocol that's basically come and pay the open market interest rate of what it is to borrow a validator, to actually attest to blocks and make blocks on Ethereum. FraxETH V2 is the first one.
Yeah. And go ahead, Kit.
I just wanted to double click into this interest rate thing because Sam, that was a perfect segue into this topic. Can you share a little bit about how the Curve AMO kind of ensures there's almost this floor interest rate, like this floor earnings for anyone who were to mint FrxETH?
Yeah, so the Curve AMO is something I think everyone knows about, that's in the Frax ecosystem, which basically is like, it's a smart contract that manages liquidity in some curve pool. Originally, we designed it for the Frax dollar peg stablecoin, right? And we obviously have one for FrxETH, the ETH pegged stablecoin. There's a big FrxETH ETH pool, right, that trades between FrxETH and ETH, keeps the peg tight. For the FrxETH V1 design, the amount that actually goes to the curve pool as protocol and liquidity is just set to 10%. Governance can change it, but it's just set to 10% of the balance sheet of ETH, just as protocol owned like liquidity, right? In this curve pool. In FrxETH V2, it's more dynamic and basically self-managing, which is any of the ETH that's not borrowed from the lending pool, you don't want it to just sit in the lending pool, right? Like right now, if you look at Aave, for example, or Compound, if you lend ETH in there, right, and you get out a ETH, it's just sitting there waiting for someone to borrow it, right? It's not doing anything. It's not like staked, obviously. It's not anywhere else, right? It's just sitting there doing absolutely nothing, right? For FrxETH V2, the ETH is not going to sit there, right? It's either staked and earning rewards because someone's borrowing it, or it gets sent to the FrxETH ETH pool through the Curve AMO, right? And that is managed as protocol owned liquidity. And the reason that's really good and really safe is the one half of it of the Curve pool is ETH, right? The other half of it is FrxETH, which is a stable coin. It's the protocol's own liability, right? So there is no way that ETH will be lost. Obviously, smart contract risk, aside, everything is smart contract risk, right? But there's no economic way for the protocol's CR to ever go down, right? Because if you buy FrxETH from the Curve pool, right, you put in one ETH, right? Now the protocol owns that ETH, right? Or if you put in ETH and take out FrxETH, or you put in FrxETH and you take out ETH, it's all basically one-to-one swap, right? And that goes into the Curve pool to earn trading fees, to earn CRV, CVX, right? And these kinds of things. And then that's also makes the Curve pool really, really liquid, makes it so that if there is times where, the withdrawal queue is deep, which right now there isn't, but, there obviously has been times where it's been very deep. The withdrawal queue doesn't affect really the peg price of FrxETH, because there's a very, very deep Curve pool that actually is always trading at all times.
Yeah, but I really like... Yeah, go ahead, Kit.
I just want to finish the last point about the curve pool. Is like, and when interest rates is say super duper high on the lending side, then the Curve AMO would actually pull some FrxETH and put it back into the lending pool so that the interest rate comes down a little bit, right?
Yeah, exactly. So the cool thing is the Curve AMO is actually, right, part of the lending pool, so to speak. It's actually kind of a very elegant concept because the lending pool and the Curve AMO are basically protocol controlled ETH, right? And so if someone wants to come and borrow ETH to run a validator, right, and there's no ETH in the lending pool or there's not enough, what they do when they initiate the loan is the lending pool tells the Curve AMO, hey, take out some ETH, right? Like just, use the LP tokens, the AMO controls to take out some ETH, right? And then send it to the lending pool. And then the lending pool sends it to the borrower, right? To spin up a validator. That actually makes it so that the optimum amount of the Curve AMO is basically market set, right? Like I said, right now, 10% is just kind of hard coded for FraxETH v1, right? It's just like a governance parameter. But the amount that goes in the Curve pool can just basically be a market set parameter based on how much ETH is idle that borrowers haven't actually borrowed, right? And so that's very cool. It doesn't really need a lot of managing.
Oh, so that 10%, could turn dynamic one day, you're saying?
Yeah, for FraxETH v2, you can take off the hard coded, the ceiling, right, of 10%. You could just say, well, however much idle ETH is not borrowed, that's just in the Curve AMO earning yield. But if borrowers want it, right, they can pull it and put up a validator for it. Yeah.
Yeah. Well, and so when there's high demand, yeah, go ahead, Kit.
So theoretically, the utilization rate is essentially we can have a target utilization rate, and the Curve AMO is basically this lever that we pull to be like, okay, we want to increase the utilization rate, so let's take out some and dump it into the Curve AMO, and hey, the utilization rate is super high, let's pull some back out, put it back into the lending pool, so we bring that utilization rate back down to like a good rate. That's kind of the idea.
Yeah, exactly. Governance can totally do that. It can even set different rates if it wants to. Exactly.
I see the DeFi Trinity here at work, and I'm wearing my DeFi Trinity shirt right here. How they all interplay. It's like, okay, you have the ETH in the Curve AMO or in the Curve pool, the AMM, and based on demand, it's being lent out. The FrxETH stablecoin is being lent out, and it's like the stablecoin Trinity is just right there.
Yeah, we try to just design everything. Yeah, like it's just basically we try to look at everything financially, right? Like, and sometimes people don't think about stuff financially, especially like LSDs. They think it's like a
technical thing.
Yeah, and the node operation is a technical thing, but the actual financials are not, right? They're lending markets. It's a financial primitive.
Yeah, and for those at home who aren't familiar with the stablecoin Trinity, I mean the DeFi Trinity, it's the stablecoin, the AMM, and the lending market, and that's basically and the more abstract version of that is Stablecoin Maximalism, which you ultimately designed the FraxETH system with. And so, can you talk about a bit with like FraxETH and Stablecoin Maximalism and like how like FraxETH v2 plays into that?
Yeah. So basically, the whole concept of like stablecoin maximalism, and I think Dave, you probably know this better than anyone because you had studied that speech and stuff that I gave at ETH Denver. Is like a lot of stuff is just stablecoin issuance, right? Like bridges issue stablecoins. They just happen to call their stablecoin the same thing as the wrapped DAI or something, wrapped USDC or whatever, and our whole premise is that the most valuable thing you can do in DeFi is essentially make it so that your issued liability is the thing that everyone uses as money, right? And ideally, your issued liability is trustless, decentralized, does not require you as the protocol designer or whatever taking custody of any of the collateral, right? Just like how FraxETH v2 is fully decentralized. But the most important thing is it's used everywhere as money, right? Like FrxETH is used as ETH, right? And there's a lot of stuff that is a little bit farther out, but in terms of alpha, like we're obviously working on like Frax Chain. It's a decent way out, so at least like 6 months. But if you think about it, Frax Chain should use FrxETH as gas, right? And so there you have a new chain, right, that actually can use FrxETH. The liability of the Frax protocol is gas rather than ETH itself, right? And that makes it even more useful, right? And there's a lot of other places that we want FrxETH to essentially be the same thing as WETH, right? And AMMs in other places. And that's the ultimate way that you earn monetary premium, right? Monetary premium is the idea that, like, you know, people are using USDC, they're using Tether, they're not expecting them to pay yield. Obviously, they'd love for them to pay yield, but like, look, Tether has 80 billion Tether, and they're not paying yield in it, right?
Yeah.
And so the same thing is the terminal state for a lot of DeFi primitives should be if you can issue a liability and have monetary premium for that liability. So everything we do at Frax is basically building towards the future of like our issued non-custodial, decentralized stable coins being that useful, being useful enough where people use it as money.
And from what I understand in the group chat, because I remember seeing when FraxChain was talked about, because of EIP 1559 and ETH getting burned, during transactions with FrxETH, for that happening, then that FrxETH just getting burned, which means it's just like, the monetary premium increases. Did I get that right?
Yep, exactly. And so, like, for example, Frax Chain is slated to be a hybrid rollup, right? Which means obviously it pushes state to ETH mainnet, and the gas is denominated, in ETH or 1-to-1 in FrxETH. And so, as people use Frax Chain, right, then the amount of FrxETH used, right, in the ecosystem will increase, right? And so that FrxETH can be burned, or it could actually be distributed to VFXS holders. That's one thing we haven't even talked about, which is like you have VFXS holders on mainnet, right? And one thing that's really interesting that we're thinking about is, what if VFXS holders can vote on what group of people run sequencers for Frax Chain, right? Like you can actually have a system where the sequencers are fully decentralized, and on mainnet, VFXS holders vote on which entities or addresses can actually operate the sequencer, which batches and pushes proofs to the Frax Chain rollup contract, right? And so that itself can be auctioned, right? Sequencer auctions are like a thing, right? So sequencers that think that they can make money, right, on fees and things like that, they pay VFXS holders to actually run sequencers on Frax Chain, right? That's very, very profitable for VFXS holders. And all this stuff can be done on chain because VFXS is staked on mainnet, right? And so the elections and the auctions happen on mainnet itself, right? And then the fees for Frax Chain in FrxETH are paid to VFXS holders. That's super simple, right? With the proof that you batch, you just send the FrxETH also to the VFXS yield contract. Think of it like kind of like how Curve right now, VECRV holders get fees for like the swaps on Curve. But imagine if it was actually just a roll up, and the fees of the roll up get sent to the VE, CRV holders. Imagine if Curve had like a Curve chain or something, right? And it wasn't just the fees of the AMM that get sent to VECRV holders, but it was the fees of the entire roll up, right? For example, Arbitrum is making millions of dollars of fees, right? Like you're saying, Dave, that can be burned as well. That can also just be sent to VFXS holders in a trustless manner because it gets pushed on chain, just like where the proofs get pushed on mainnet.
Wow. We came in for FrxETH, but wow, we're here for Frax Chain. I think you should call Frax Chain Fractal. I feel like that would be a cool name for it because I always now I've been thinking of Frax being like a microcosm of DeFi. I'm like, oh, it's a fractal. So I feel like you should put that into consideration.
That's a cool name. Fractionalism is also kind of cool because it optimism a little bit, but you don't want to make it seem like it's just like a copy, but it also is a cool thing in the running. I think it should just maybe have a different name than like the word like chain in it, because I'm not sure if all chains have like cool names, right? Like Ethereum or like Phantom, Polygon. There's only, I think the only major chain that has the word actual chain in it is like Binance Smart Chain, but like that's it.
And another thing that's been like researched and been a big topic quite recently in Ethereum is account abstraction. And when creating, FraxChain, Fractal, are you guys going to utilize account abstraction at all, like in 6 months or a year when it comes out?
Yeah, so account abstraction is really interesting because it allows you to do a whole host of stuff, from obviously smart contract accounts, gas abstraction, so people don't have to pay gas. Technically, it can be outsourced, or there's like social recovery wallets and these kinds of things. One thing we're like looking into is if all of the accounts on Frax Chain at like Genesis can actually just be smart contract accounts. That would be really interesting to just have a roll up where from day one the ecosystem is built on account abstracted wallets rather than EOAs, right? Because it's difficult to just go from EOAs that everyone uses to like smart contract account abstracted like account based systems. But if you start a whole roll up from day one where like everyone's is basically these smart contract wallets, that would be really cool. Then what you can do is you basically, it's almost like a bank account, right? Where it's a fully programmable bank account, right? You're like, I want, my wallet is a deposit account of like dollars, right? There's Frax in it, and then there's some ETH, right? And you stake it as FrxETH, so it's earning interest, and then maybe you unstake a little bit of it to use as gas, right? And you can do social recovery. Obviously, you can do these other things, but it's almost like Frax Chain is like a decentralized bank account, right? That's like fully programmable. You can build on it and stuff, and that's really cool, right? That actually is a really unique take on what a fully decentralized chain should be, rather than the 50th alt L1 or L2 like build an ecosystem of we'll give grants and stuff like that. It's a different vision for what it should be.
Got it. Sam, all this talk of Frax Chain is just getting my wheels spinning here, and I would love to hear from you. What do you think are the next products and things that needs to be built to get us on this road to Frax Chain? Obviously FraxGov is coming, FrxETH V2 is here, Frax V3 is coming down the line too. Like all these things are simply marching us marching us towards this Frax Chain future. So I'd love to hear what you think we need to build next.
Yeah, and obviously I always caveat this, like this is not financial advice or anything, but I think a lot of people are probably underestimating or like undervaluing kind of all of the stuff that's coming, right? They're just because right now is pretty bad time in the market, both regulatory, macro, high interest rates, and all this stuff. And so like people look at token prices and FXS and stuff, and again, it's not like it's investment advice or stuff, but when I look at it and I just see like people's like kind of vibe check or something, right? And then I think about the kind of stuff that we do have coming, that we are building, and I like look at the end state of what I know, and I feel confident of what the Frax ecosystem will look like in 1 year, in 2 years or something. I just think like the current price. Yeah, exactly. Like if we can do this properly, if we can actually push this out, which so far we've been able to do, slowly, step by step. The stuff that's left, like Dave said, FrxETH V2, the BAM, Frax V3, the stablecoin, and just a lot of new kinds of stuff we're doing. More decentralized self-serve FXS gauges. You don't have to like ask us to deploy it or anything. It's a totally new system. That's something like I'm working on. The system where you can lock more liquidity efficiently, and it's more decentralized, and just a lot of these updated things that need to be pushed out, and these big releases like the Frax v3, all of those things kind of will culminate with the Frax Chain launch. And then once all of them are there, like I was saying, there's just so much diverse areas where the protocol issues non-custodial decentralized stable coins like the ETH, like LSD, right, like the dollar one, like FPI and stuff. And there's just such a wide diverse range of like places where there's revenue to VFXS holders, sequencer auctions, right, like BAM trading fees, lending and borrower fees, right, from FraxLend, and the FrxETH v2 protocol fees and things like that. And it's just it's like a global economy, right? But slowly we have to be able to push things out step by step.
Slowly, then all at once. The
Exactly.
fractal reverberates throughout the universe and on chain. Wow, I was not expecting all this alpha. I'm very satisfied with it. Kit, I'm not sure if you have any more questions. We can just go right into the lightning round from here if you don't.
Yes, go right into the lightning. This has been more than enough.
Yeah. All right. Since this is your fourth time on, I believe. Yep, fourth time on. We got to get creative here with the lightning round questions. And so I'm gonna go ahead first. So Sam, if you're any fictional character, which one would you be and why?
Oh shit! I think Batman. Always my favorite superhero because he doesn't have superpowers. He's just super smart and has the coolest gadgets.
Yeah, and he's all black. Same colors as Frax.
Exactly.
Yeah.
Because someday Sam Kaz can actually be Batman. That's why it's a reality. Okay. Question is, if you could time travel back to any period of time or forward, where would you go and why? When would you go and why?
That's a good question. Well, let me just do, first of all, if I'd go backwards, I'd go back to talk to Immanuel Kant. He's one of my favorite philosophers. I was a philosophy major and neuro major. I really like his writing. So back to that level, to front, I'd go to time where there's a full brain-computer interface with AI and humans to see how that actually works out.
What would you ask Kant?
How he came up with both his Critique of Pure Reason, the work, and the categorical imperative.
Yeah. Yep. Okay, next question. What's the most unusual food combination you've tried and actually enjoyed?
Ooh, that is really interesting. Let's see. I've had alligator jerky in in Miami. It's actually and I thought it was pretty good. It wasn't. It was a little bit gamey, and then I had it with sushi, which is kind of weird, but it was pretty decent.
Kit, me and you both, right there.
Yeah. Awesome. And then I'm just trying to think of what was the one thing that happened in your, whether it be advice or an experience that really impacted who you are today?
That's a good question. Honestly, I just always come back to and I say this a lot, but just thinking about positive sum and the good in people is something that impacts me a lot. Not a specific event, but just, there's a worldview where people are inherently, good. And then because of bad incentives or bad circumstances, they might act in a bad way, right? And then there's a second worldview, which is people are inherently bad, and you need good incentives and you need fear or whatever to make them act properly, right? I was never that second type. I always see the good in both humanity, but also just even in smaller stuff, in positive sum workings with crypto projects and everything. So something that's just impacted me a lot in not a specific event, but just thinking about the world always in every aspect as a glass half full kind of person, rather than the default being the glass half empty, right? Rather than the default being like people are inherently like bad, it's only incentives that make them act good. It's people are inherently good, and sometimes incentives might cloud their judgment or have them act badly. So that's I always come back to, positive sum mentality.
Well said. And my final question is, who do you think should be our next podcast guest? You have any recommendations?
Ooh, that's a great question. Well, what do you guys think in the crypto space? Like, have you seen anything really interesting? Like any projects come up recently?
We just interviewed the founder of Infinity Pools.
That was a great
That
one.
was one. Yep. That's gonna be a real deep cut. Other than that, I'm trying to think. I'd really.
I see what you're doing here, Sam. You can't throw the question back to
hey,
us.
Hey.
Oh no, I'll answer. No. The Infinity Pool thing is good. I'll answer though. I think, to be honest, I think if we get actually like a diverse set of like people, like for example, even people that like Frax hasn't like worked directly with, like someone from Uniswap or Maker or something. I'm always, or even like Lido and stuff like. I think building inroads and like I was just saying, and trying to always extend like a hand of friendship rather than like a hand of like zero sum, right? Competition, none of that is really cool. So anyone from Maker, like Paper Imperium is really cool.
Right?
Right?
He does a lot of advocacy stuff in DC.
Yeah, I think right now he's working on interest protocol or something like that, but he's just so knowledgeable on so many things.
I think having
really cool
him and Sam and a few other people would be good, and Hexanaut would be good.
Yeah.
We should. I've been meaning to have them on, honestly, but it just hasn't matched up. But maybe soon after this one. I think that's it for me. Sam, thank you so much for coming on. With all the alpha, and we're really excited to have you back on again soon, hopefully soon for Frax V3.
Yes, sir. Thank you guys.
Thank you, man.
Yeah.
Well, this is a post-game episode for the fourth time that Mr. Kazemian has come on to Flywheel, and we learned a lot, didn't we?
Yeah. We were coming into this just to talk about FrxETH V2, but then we got Frax Chain. We got like
I knew that was coming.
Yeah, of course. Like the last third of the episode was just like everything you need to know about Frax Chain so far. And I think we're all, because all that's just so new to us.
Yeah.
But anyways, guys, what are your initial thoughts on this episode?
I've been very impressed with how the mental models around everything that we're building, and essentially everything in the e-space as well too, is going to like radically change over the next 6 to 12 months because of the single effect of providing a interest rate for validators to borrow ETH. Like everything that comes out of it, of saying, okay, here is the base rate for giving someone else your ETH and letting them go and do something with it. It just brings on all these other things combined with like the Sam's like stablecoin maximalism ideas that as long as you have like a base rate in crypto that says you're going to make 3%, 4%, whatever it is, doesn't matter. As long as you have that like base interest rate, now you can split off the collateral versus the yield, or the principal versus the yield, and you can do so many things with it. And it is just incredible how this simple shift in the mental model for Frax has unlocked everything, just from like FrxETH, and then we talked about Frax Chain, and every other product that they're building is going to be incorporating these ideas into it. It's so cool.
Yeah, I feel like you can write a whole article about that. Especially how, can you go into a bit more how you think like over the next 6 to 12 months, things are going to radically change? So, there's going to be this like floor baseline rate of like return in ETH. and then Frax is basically creating a market for like trading that for the interest rate, right?
Yeah, exactly. Frax is saying like, here's the baseline that you can earn for ETH, and like the assumption is that like all ETH validators kind of make the same right now, right? But what we're seeing, from our eigenlayer interview plus everything else, is that there's a ton of new tech that's coming, which is going to like radically change the amount of profitable opportunities that people can engage in. So, say you want to, spin up a like it's easier on like AVAX, right? Because they have these things called like subnets, right? You spin up a subnet, you have your own token that runs in that subnet, and it gets paid out. Like you have these like pockets of like profitable entities which you can attach your validator to. And so we move beyond the baseline of like everybody's just doing something for consensus, and now we have this like entire world global system of other opportunities that you can engage in to like increase your yield, and you base that against the FrxETH yield.
Yep. That's why I asked Sam during the interview about like how the Curve AMO effectively sets the floor for what this interest rate will be, and who sets that? Well, the FXS bribes sets that. So it really comes down to like there's going to be a floor yield, and I could imagine that as a growth tactic, the floor yield on the Curve AMO is going to equal what say Lido is paying out. And that's the target, so that everything on top is going to be a bonus. So why would you use Lido when you could come over and use FrxETH, where the floor is going to be what you get at Lido and the upside is kind of infinite, especially once they start incorporating into the eigenlayer stuff, right?
Well,
I definitely think
eigenlayer is just like an idea. Eigenlayer just says that like there is a base yield that you earn for ETH, which is going to be the FrxETH yield. And then we're building all these applications which are using the security guarantees of ETH on top of it, and they provide extra yield incomes. So like as a validator now, you assume going forward that like the opportunities are just going to get bigger and bigger. And maybe there's something where like you can earn 10%, but the yield, but like the base borrowing rate's only 5, right? Or like 12 or 15 or 20. And we're going to enter into like an entire new paradigm of like ETH staking opportunities.
Yeah. But I think a big issue though is like, as the ETH staker, maybe I don't want my validator to go so ham and go into re-staking and open up so much more slashing. Because there's only 4 ETH. There's only 4 ETH collateral, you know what I'm saying? So it's like, I think there's going to be, it's going to evolve, right? On day one, it's not going to be this complex re-staking marketplace. It's going to grow over time, and people are going to be able to differentiate, hey, this validator, I mean, the current utilization rate is so high and so expensive. That means everybody is re-staking. Now it's time for me to pull out some ETH so that I don't participate in this crazy bubble of re-staking.
Yeah, but I think that's the risk that goes forward, right? So like when we talk about like the risk-free rate, right? The risk-free rate is going to be the FrxETH minimum borrow rate. Because like why would you stake with Lido or somewhere else where you could go to Frax, right, and get like the risk-free rate? But then like as the node operator, now instead of just settling for these like baseline opportunities, I think the you move away from this like socialist protocol aspect where both the profits and the losses are socialized. Like, so if you're an RPL and there's like a really good MEV opportunity today, like it's socialized across the entire validator set, right? Or same thing with Lido as well too, right? But now if you're able to capitalize on the MEV or whatever sort of like opportunities, we'll just call them like block opportunities. If you're able to capitalize on those, you can outpace the like base market rate, the risk-free rate, and make a ton more money by running a very knowledgeable, profitable
performance
infrastructure operation.
Yeah, I think that's the whole design of this whole thing. And
I
just don't know when. I mean, we're fast forwarding way too far now, but let's say there's an oracle that wants to use FrxETH security, and it's just that one little extra like toggle to be
Yeah.
like degen mode.
Oh, and it adds on, and it adds on like an extra percent. It adds on
Yeah.
an extra percent every year. Like think about all the opportunities. Like if you internalize, we talked to the eigenlayer guys. If you internalize all that security budget that's gone to all these different protocols, right? And now you just put it into like ETH validators, like there's so much opportunity. And like the yield is not going to be like a 4 or 5%, right? That's the base. It's the risk-free rate. Everything after that is going to be this like upside opportunity that you get to run as an infrastructure provider. And it's I think there's huge amounts of potentiality here for competent node operators who may like taking risks by providing their services to different networks, right? Can just make way more than this like base interest rate.
Sam, Dave, and I hear you. We will have Flywheel nodes. Don't worry about it.
So like, look,
validators.
The thing that Sam figured out, right, is that like everything's a loan, and that you just have to be able to like quantify that. As soon as you can like turn that into a product, now you have something which you can build upon, right? Like think about it like this. Like come here, baby. Are you happy? She's happy. So think about it like this.
Pumped about
She's
FrxETH
excited.
I'm going to imagine a token here, and this token is the spread of the yield between my validator set and the FrxETH baseline rate. So let's say that I have a Frax, like I have a really profitable operation, right? I could sell the spread as
sure.
like a fixed rate or like a floating rate that somebody could buy, and they could buy that cash flow as and then I could just sell it off and then pocket it for like either my DAO or protocol or entity or whatever it is. Like that's not possible before, but like once we have the Frax rate, now we can do that, right? Now we can make that sort of token that it just engages another layer of financialization.
Wow.
Just,
This is the Sam post game.
it is,
And I'm all for it. I'm all for it.
Yeah.
Look, I've just been thinking about this a lot recently. And the stablecoin maximalism was just the first point, right? That we separate the yield and the principal. But once you do that, you like look at all the different things that you can do in TradFi once you have those abilities. And there are infinite types of products that you can build that just were not available before.
Yeah. And we're here for that future.
Yeah.
And if you want to be with us every step of the way in that future, you got to do. You got to hit that bell button and subscribe. Give us a like. Leave us a comment. Let us know what you think. Follow us on Twitter at Flywheel DeFi. Make sure you join our Telegram group at Flywheel DeFi. You can follow me on Twitter at DeFiDave22.
You can follow me at 0xcapital_K.
And I'm at traders_insight.
We'll see you next week.
Yeah. Peace.
Everything said on this episode is not financial or tax advice. This channel is strictly for educational purposes and is not an investment advice or solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice whatsoever. Please talk to your accountant and do your own research.